Welcome to Fund to Money. Here we are discussing taxation of equity investments, which includes shares, equities, and all equity related equity oriented mutual funds, which is equity funds, and those who have for tax purposes are considered are taxed as equity funds. So they'll have a large equity component. So that's what we are looking at. Why is it important? Yes, of course it is important because you have to file your income tax. You need to know how much tax you need to pay. But more important is when you're actually making a choice of investment, tax is an important factor that you need to keep in mind. And most of the people actually oversee it. So therefore, a lot of times we get these questions about should we buy something now, should we invest in something now, should we move out something now. You need to keep in mind that when you're moving out of an investment, that's when you have to pay tax, especially in equity investments where you need to pay capital gains tax. So you need to keep that in mind. So it's not just about tax filing, it's also about the choice of investment and how long you stay invested in certain investments. The longer you stay invested, the greater the returns. For instance, in equities, if you stay invested for the long term, that's 8 to 10 years, you get returns much higher than, typically you get returns much higher than other asset classes, which would be debt, gold or real estate. So you need to keep this in mind, and that is why a discussion like this is so important, because some of the common questions, some of the common mistakes people, some of the common questions people ask and the common mistakes they make all move around this. If you are clear about this, then you probably will make better decisions. So we'll come up with the details in just a little while. Don't go away. Welcome back. Welcome to Fund to Money. We are talking about tax on equity investments, which includes equity mutual funds or equity funds, regular equity shares, equities, and all equity related equity oriented mutual funds which are considered as equity investments for tax purposes. So we're talking about that. Now, what are the tax rules? Why is it important? We just mentioned it. So let's get started. So if you have stayed invested in such an investment, which will be considered as an equity investment, then and you have moved out of it within 1 year, so then it will be considered, the gain that you make will be considered as short-term capital gains. Therefore, for these gains you pay short-term capital gains tax, which is 15%, and that's how, and the rest is all, the money is all yours. So it's not a small amount for a so basically this means is you have to make a very healthy sort of gain to be poorer by 15%, right? Then if you have stayed invested for more than a year, then it is considered as a long-term capital gains, and you're taxed at 10%, which is long-term capital gains tax. You pay long-term capital gains tax for a long-term capital gains. That's 10% you have to pay, provided the long-term capital gains that you made is more than 1 lakh. So if it's more than 1 year, you make very good gains, then you pay 10%. Now the question is, if an investment is rewarding you so much, then you might as well stay invested in them. And the other important thing that you need to keep in mind, that in the initial period of equity investment, things go up and down in the initial period. So if you've done that, so what may happen is you might actually see a downturn in the fortunes of the investment, but over a period of time, say over 5, 6, 7, 8 years, things start stabilizing and you get a return which is much higher than competing asset classes. Now remember here that if you're making regular investments in equities, which is like a systematic investment plan, SIP, then important thing for you to remember is whenever you're making the investment, your clock starts from there. So suppose you're making an investment of say 10,000 in an SIP today, then your time for this particular investment starts from today, right? If you're going to next month's for the next month, it'll start from next month. And so suppose somebody is making an investment on January 1st, 2021, and he makes an investment of 10,000. So the 1 year period will end on December 31st, 2021. So that is how it will work, right? For February 1, it will be January 31st, 2022. So that's when your 1 year for that particular investment will get over. So you need to remember, you need to understand how this is happening. Why are we even dwelling on this? Because there are a lot of people who talk about discontinuing SIPs in equity funds and other places. This is what you need to keep in mind, that when you're going to move out, are you move out at a loss or whatever, or you're not going to be gaining or whatever. And then what is the tax? You will not be able to get all your money in your hand, or if you get it in your hand, these are the implications that you need to keep in mind when you're looking at equity investment and equity funds. Of course, the same holds true for shares as well. Now, before we conclude this discussion, it's worth mentioning that dividends is also another area. A lot of people used to invest in dividend. It used to be tax free. It's not so anymore. You're getting taxed. Before, tax on dividend used to be paid by the companies or the mutual fund organizations, asset management companies. There used to be dividend distribution tax. It used to be tax free in the hands of the investor. Not so anymore. You have to pay a tax. Right now, when you make capital gains, then that income comes under, there are 5 heads of income as far as income tax is concerned. So it comes under income under capital gains, and this one, dividends, comes under other income, where your interest figures are also figures, and some other pension and other stuff, other heads figure. So dividends are taxable. They're going to be taxed at your income tax rate. It's a recent change. There's a TDS that will get deducted from any particular source, provided the dividend payment is more than 5,000 rupees. So these are some of the things that you need to keep in mind. Clearly, the tax laws are such that they encourage you to invest in equities for the long term. This is the message that you must understand and grasp. So if you are not looking at a long term investment, tax laws are such that they discourage a short term participation in equities. So longer you stay, lower the tax you pay, higher the likely return. There is no guaranteed returns, as we know, but the higher the likely return. So this is the central message that you must grasp when you're investing in equities, and when you're understanding how equity funds and equities are taxed. We hope you found this useful. If you like this discussion, hit the like button, share it, subscribe to our channel, and get connected with us on all leading social media networks. Till the next time, take very good care of yourself, and goodbye.